Hello everyone and welcome back to these sessions on derivatives for CFA Level 1. Now in this class we are going to begin with the discussion on options. After understanding everything about derivatives in the initial classes, if you can recollect, we started understanding that how does a derivative derive its value from the price movement of the underlying. When we started learning that concept, the very first example we took of an option itself, correct? The first thing that we learned was an example from options. But eventually, when we continued with our discussions, we took more of forwards and futures into our discussions. But now, let us explore everything about options and how options work as a derivative instrument. How do these kind of contracts emerge? What are the advantages and risks involved in options? Beautiful concept, and you are going to just enjoy it, provided you are keeping complete attention in understanding this concept. So first of all, if we look into a forward contract, just for you to recollect, say there are two parties involved in the contract, A and B. A is having bullish sentiment, believing that price of a particular stock will move up. B is having bearish sentiment, expecting that the price of the same stock will move down. So A would want to buy that stock at the negotiated price. B would be happy to sell it at that price. C is, if the idea is the price is going to move down and you are already contracting to sell it at an agreed or negotiated price which the seller believes to be considerably higher, the seller is happy selling the stock at that price, the buyer is happy buying the stock at that same price. But say the contract is going to settle after 3 months, either the price will move up or it will go down. If it moves up, A wins the game. If it moves down, B wins the game. Clear point, right? Either of the party will be benefited. So A's gain will be B's loss. B's gain will be A's loss. That is clear. Now what happens in forwards and futures? Suppose A is making a loss. In spite of that, A will have to settle the contract. That means if there is a loss, you have to pay for it. If there is a gain, you take the gain from this contract. Options on the other side gives you a very good advantage, that you participate in gains and do not participate in loss. For example, if I make you play a game of dice, that you buy a ticket of rupees 10, you roll a dice, and if the dice shows 5 on its face, you win the game. I give you 100. If you lose the game, you don't have to pay anything. You just have to buy the entry ticket for playing this game. So what do? You give me rupees 10 as an entry ticket to play this game. I throw the dice. If the dice rolls and shows the face as 1, 2, 3, 4 or 6, I win the game, you lose the game. But you have already paid for entry ticket. Now if you lose, nothing else you have to pay. You quit the game. You lose only rupees 10. But if you win the game, you get back rupees 100. So actually speaking, what happens? 10 times you play the game, even if you win once, your net payoff will be enough to bear the loss of other 9 games. That is the advantage in case of options. But if you are losing, what you are losing, don't forget, you are just losing that entry ticket. On the other side, I'm the counterparty, I'm taking all the risk. Just to get that entry ticket price, I am taking that risk. I am making you play the game and you are the player. I am making you play the game. Now this exactly happens in the option market. There are two parties involved. The person who plays the game becomes the option holder, and the person who makes the game play is the option writer. That means the provider of the option is the one that is making the counterparty play the game. The buyer or the holder of the option is the player of the game. Anyway, if you can understand that simple example of rolling a dice and winning or losing the game, where the player has to just bear the loss of entry ticket, nothing beyond that, indeed you have started understanding the option contract already. So first of all, option contracts are contracts that do not bind the option holder to settle the contract. It is at the choice of the option holder. That is why it is called option. You have a right. You don't have an obligation. You have only and only the right. You do not have an obligation. If you are the option holder, it is your choice whether you should let the contract get settled or just leave it as unsettled. You don't have to undergo any obligation to perform. If you are holder of the option, it is purely your choice whether you want to settle the contract or you do not want to settle the contract. It's completely your choice. So say you have option to buy a share at 400 rupees. Now if the market price of the share is 380, why would you exercise your option and buy it at 400? Your option is worthless. Just let it go. Let it lapse. On the other side, if the market price of that share is 480 and you have the right to buy it at 400, your option carries value. Then definitely exercise that option and buy the share at lower price, at the contract price, that is 400. The same share you can sell it in the market at rupees 480, thereby making a gain of 80. And if it is an option contract which is not OTC type but exchange traded options, then you directly get that gain of 80 added to your pocket by termination of the contract. This is the advantage of option. It's one-sided. The holder of the option just has a choice, and that is why initially you have to pay the entry ticket. That entry ticket is nothing but what we call as option premium. Correct? Option premium is the price that the holder of the option has to pay to the counterparty who is the writer of the option. So the two parties involved in an option contract, option writer, option holder. It is the option holder who has the choice. It is the option writer who gives that choice. The choice held by the option holder could be a right, not an obligation, but it could be a right to buy or it could be a right to sell. If it is a right to buy, it is known as a call option. If it is a right to sell, it is known as a put option. So options could be either call options or put options. Call options convey the right to buy, put options convey the right to sell. But who can exercise this right? The holder of the option can exercise the right. Writer of the option, the counterparty, is the provider of the option, and the choice is always made not by the writer of the option. Choice is always made by the holder of the option. What I am going to do is give you important notes stage by stage. Let's not rush with the topic. Let's make sure that your understanding becomes crystal clear. At any point you have any confusion, we will knock off that confusion on the spot and we will then only move ahead. So be sure when you are noting down any point, ask yourself couple of times that are you clear with that or not. Then and then only we move forward. So let's do one thing. Let us write up some important notes first about the basics of options. Options are such derivative financial instruments that do not bind the option holder into a firm commitment. Look at these lines. Do not bind the option holder into a firm commitment. It just gives you a choice. So, option contract provides the right to the option holder to buy or sell something in future at a price agreed today. Look at what it is conveying. It is conveying only the right to the option holder to buy something or to sell something in future, but at a price which is agreed today. Such agreed price is known as exercise price or strike price. Let us take an example to understand the whole matter. X and Y enter into a contract where X will have the right to purchase 1000 equity shares in NJ Limited at a price of rupees 32 per share on 31/8/2025. Right now, today, when I am discussing this concept with you, it is mid of June 2025. So, from now, roughly in 1.5 months time, this contract will be due for settlement, correct? So, if this contract is going to be due for settlement in 1.5 months time from now, the choice is with the holder of the option, that is X. So, X is the holder of the option, Y is the writer of the option. If X wants to buy these 1000 shares at price of 32, X may choose to exercise the option. If X does not want to exercise the option, X is under no obligation to perform. However, if X chooses to buy these shares at price of 32, in other words, if X exercises this option, then Y is under obligation to sell to X these 1000 shares at price of rupees 32 per share on this settlement date. So, before I take you any further as an analysis of this example, I want you to note down this entire matter and then we move ahead. Alright friends, once you have completed writing this much and if you are clear with this, let us proceed ahead with the analysis of that example. So, let us analyze the above example. Here the contract is an option contract where X is option holder and Y is an option writer. The underlying component in the contract is equity shares in NJ Limited. This derivative contract is known as call option as it provides the right to the option holder to purchase. The exercise price or strike price is rupees 32 per share and the maturity date for this option contract is 31st August 2025. This can also be referred to as settlement date, but maturity date is fine as of now. So, please write up these points as well. I have explained to you already. Write it quickly and then we move ahead. Alright friends, once you have completed writing this much, let us move ahead and continue further. On the date of maturity, the option holder, that is X, has a right and not an obligation to buy such equity share. However, if X exercises his right to buy, then Y will be under obligation to sell. Therefore, option holder is always at a benefit. But do you think this benefit will come to the option holder free of cost? Absolutely not. That is where the option holder has to pay some premium to the option writer. Means, if you can recollect the example of rolling of the dice, that game that we played, where I was making you play the game and you were playing the game, the entry ticket that you were buying is basically the price of playing that game. So here X will have to pay to Y the price of playing this particular game. That in technical terms is called option premium. That is the worth of the option contract that X has to pay to Y. So if the option is exercised or not, this money what X is paying to Y is expense for X and income for Y. Once that option premium is paid, it permanently becomes the expense of the option holder and it permanently becomes the income for the option writer. So let us continue our discussion ahead, and after writing these points we would say, for such benefit the option holder has to pay premium to the option writer. Such premium is payable on entering into the contract irrespective of whether the option is exercised or not. So whether the option is exercised or not, the premium is payable upfront on entering into the contract. So quickly take note of these important points and then I take you ahead. Alright friends, if you have completed writing this much, let us move ahead and continue further. Parties involved in options. So we have already discussed this point as well. The two parties involved in an option contract are known as option holder and option writer. Option holder is the buyer of the option and option writer is the seller of the option. So option holder, one who has the right to buy or sell. Option writer, one who provides or sells such right. So I have explained to you this whole thing already. You just need to take note of this. So write it down and then I move ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Options provide rights to the option holder to buy or sell something at the contracted price. The option holder is under no obligation to settle the option contract. The action to be taken in this regard is solely at the discretion or choice of the option holder. The option holder will exercise such right only when it is beneficial for the holder. If the option holder exercises the right, then option writer is under obligation to perform. We have discussed even these points. You just need to note it down and then I take you ahead. Alright friends, once you have completed writing this as well, let us move ahead and continue further. Price of an option. Now here I have seen many candidates getting confused. See, we have talked about something as strike price or exercise price. That was actually the contracted price at which the underlying could be bought or sold. That is not the price of the option. Price of the option is what the holder or the buyer of the option has to pay to the seller, which we also call as premium. So factually, it is the option premium which is the price of the option, because that money is paid by the option holder to the option writer to get that option or to acquire that option. Correct? So option price is not the strike price or exercise price. So when we are dealing with examples ahead, you should be having tendency to understand what is strike price and what is the option price. For example, right now I say that I will give you right to buy shares in Tata Motors at rupees 1200 each. After 3 months, I am allowing you a contract through which you can buy shares in Tata Motors from me. I will sell it to you at rupees 1200. It's an option. It's your right. You want to buy, you buy it. You don't want to buy, don't buy it. But you have the right to buy the shares from me at 1200. And when? After 3 months. So that 1200 is not the option price. That is the exercise price. Price at which you can exercise your right. But you are buying this right from me today and I am charging rupees 28 for each option. For having option of buying one share from me, I am selling that at rupees 28. So it is rupees 28 which is the option premium that you are going to pay to me for every share. That option premium is the price of the option. I believe you people are clear with what is the price of an option. So let us now take up some important notes to be noted in your notebooks. For buying the option, the holder has to pay its price to the writer. Such price is known as premium. The writer of the option will receive such premium. Point to be noted that strike price or exercise price is not the price of an option. Please write it quickly and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Call options and put options. I have explained this to you already. Call options provides a right to the option holder to buy the underlying component at the agreed price. Put option provides a right to the option holder to sell the underlying component at the agreed price. So call option conveys the right to buy, put option conveys the right to sell. So write this as well and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue. American and European options. Now this is something very important again. American options and European options. These are basically the styles of options and you need to be extremely clear with what are American options and what are European options. If an option conveys a right to buy or sell something at a defined future date, that is that date only, then it is a European style option. If an option conveys the right to buy or sell something on or before a specified date, I repeat, on or before a specified date, then it is American style option. In other words, if there is a date specified in the option contract and the contract has to be settled only on that date, it is European option. If the contract can be settled any day up to that date, that means on or before that specified date, then it becomes American style option or American options. So that date when it is specified in the option contract, it is referred to as a maturity date or settlement date if it is European option. But if it is American option, that date is referred to as expiry date because the option is valid up to that date. You can exercise any time, but after that the option gets expired. So students do ask me that, sir, European options, do they not expire after that date? Of course they will also expire because they are giving you window of only that particular date to be exercised. End of it. Not before, not after. American options provide you a last date to exercise the option. That means you can exercise it before or up to that date, not after that date. European options do not allow you to exercise the option before that date or even after that date. You are allowed to exercise the option only on that date. So for European options, you may refer that date as maturity date or settlement date. In case of American options, you will be referring that date as expiry date. So let me give you some important notes in writing over here. European options are options that can be exercised only at a specified date in future. American options are options that can be exercised at any point on or before a specified future date known as expiry date. So please take note of this whole thing and then I take you ahead. Alright friends, once you have completed writing this much, let us write something about option premium. I have explained it to you already. This is an upfront price payable by option holder to option writer at the time of entering into contract. By paying option premium, the option holder buys the option and option writer sells such option. Option premium is payable irrespective of whether the option is exercised or not. In order to decide whether an option should be exercised or not, option premium already paid by holder to writer is completely irrelevant. So please write up this whole thing, and with that we will be putting an end to this session.